Welcome to the M2I Alternative Investments Chat, where we demystify the world of alternative investments and financing for entrepreneurs and investors alike. With these discussions, we hope you're more empowered to unlock new opportunities in your business or portfolio.
Hello and welcome. Today, we're going to be diving into equity. Now, if you've ever seen Shark Tank, you may have heard a little bit about equity. When people go onto Shark Tank, they're usually asking for capital in exchange for giving the sharks a piece of their business. And then if we're looking at debt offerings, that involves borrowing money and paying that money back over time. So you're not exchanging that piece of your company. Right. So again, we're kind of diving into this two-part episode today. We're going to start off talking about equity, and then we'll move further into debt. So let's break down equity a little bit more. I know that we just touched on what equity means, and equity represents the value that would be returned to a company's shareholders if all the assets were paid off. And all the debts were paid off and liquidated. So right. That at the end, you know, if the shark takes 30% of the company and the company is liquidated, that shark's walking away with 30% of the value of the company.
You're correct.
It's kind of how you can think about that. I want to expand a little bit more on Shark Tank. If you have not seen this show, which if you have not seen this show, where have you been living? Shark Tank's been on for 10 years. It's been a long time.
Be under a rock with me because I know of it, but I don't watch it. So, but I understand the premise of it. So
yeah, you know where you can always see Shark Tank is on Lifetime Fitness. For whatever reason, they always have Shark Tank on. Yes.
Well, I'm not fitness either. So we're not doing that.
So basically, you have usually four sharks that are very successful business people. And there are folks who are coming on who are pitching an idea for a company. Usually it is a product.
Yeah,
and
like a presentation, right?
Exactly. And a lot of them almost read more like infomercials. They're doing like a live demonstration of the product. Usually they're a little bit fun and witty, and they're trying to get the sharks on board with their idea.
Got it.
So they're coming on to the show and they're asking for capital to help expand their business. Maybe they want to buy a new factory so that can help build their product faster. Maybe they want to hire new staff. Maybe they want to, lower their cost of production, different things.
Well, I don't think people understand that everything costs money. Mm-hmm. And so like when you go to start a company, you don't think about all the little things like everyone needs a computer. You know, if they're going to be awesome like us and do a podcast, you need microphones, you need cameras. Like, where does that money come from?
Yeah, exactly. So there's a lot of different ways you can raise that capital. But if we're talking about Shark Tank, they're asking for a certain amount of money for a percentage stake in the company. And the sharks are using their own money to invest. And a lot of times, this also develops a partnership between that company and the shark as well. So usually you're not just getting the money from the shark, you're also getting their connections and their expertise in that area.
Okay, I follow. So have there been, how does the process work? Like, do these people just go on and pitch this idea and then nothing comes of it? Like, are there any success stories? Or, I can't imagine that every product that comes on Shark Tank is amazing.
No. In fact, sometimes the product is good, but the pitch is horrible. So people don't want to get on board. Or, you start diving into the business and the numbers don't make sense. But if we're talking about a success story, Scrub Daddy, I don't know if you've heard of Scrub Daddy, those little sponges with the smiley face.
Oh, I have heard of those. I think I have a few in my house, actually.
They're all over the place. In every grocery store, every retail center, you can get a Scrub Daddy. That is actually a product that was featured on Shark Tank. And that person walked on and wanted $100,000, but ended up walking away with $200,000 for a 20% stake in the company, which, $200,000, if you think about it, in terms of a business, especially a business that has grown to that magnitude, $2,000 is not that much money. And he had to give 20% stake. Yeah. Now, of course, this is a success story in the sense that Scrub Daddy's huge. It's everywhere.
Yeah.
And it's really popular. And Lori, I think herself has made $15 million, $18 million alone on that.
Off a scrubby. I love it.
Off a little Scrub Daddy. And don't quote me on that number, but a lot of money. It's been super successful. And obviously the creator of Scrub Daddy has found great success as well.
Wonderful.
So Erica, if we're keeping within this world of Shark Tank, just so we have a point of reference of an example, why would Lori get equity in that company? What is attractive about that to her? And what sorts of rights or privileges does she get from that?
So when you take equity in a company, you get a lot of things. A lot of times you'll get a seat on the board, meaning you might have voting rights. So let's say the designer says, hey, you know what? This whole time the Scrub Daddy's been purple, for example. And they're like, well, people don't really like the color purple. We should change the color. As an equity shareholder, you get to say yay or nay in that as well. Those business ideas need to be run by you as well. So you actually have the power to control some of that design. You get, like I said, you get direct influence over strategic decisions, and you can either veto those or jump on board. So not only do you have like voting rights within that company, when that company grows and is profitable, you as an equity shareholder also make money. So it's a great way for why you would want to raise capital in that way. But what are some other reasons do you think that firms or companies would want to raise capital with equity?
Yeah. So you kind of touched more on from the investor perspective, the powers that you get when you acquire equity. A reason why a company would want to have an equity offering is they get to raise capital without taking on debt, which again, we're going to talk about debt in this next episode after this.
Okay.
Because there are some advantages to that. But this can be especially attractive when traditional financing options are unavailable, like getting a loan from a bank. You're able to get money from folks who can just give you money, and then also you don't have to necessarily pay that back.
It's kind of nice.
With a debt repayment, you have to pay that money back over time, and with equity, it doesn't exactly work that way. And also, too, all shareholders are in line with the business mission because, like you mentioned, when the company makes money, they make money. So it's in their interest to help that company grow, which is also why you'll see on Shark Tank some of the companies that come on want to get with an investor or shark that aligns with the connections that they might need. Mm-hmm. So again, if we're talking about Scrub Daddy, Lori is known as the queen of QVC. If you know about QVC, your mom probably watches it.
Oh yeah, I have some items there.
Yeah, after her soaps, she's tuning into QVC. So basically, that was a great platform for Scrub Daddy to get on because they're marketing directly to people in their homes and calling in and ordering the product right away. So that was one of the biggest reasons why Scrub Daddy went in that direction. So those ideas and those missions are aligned.
So with equity, what happens if there's like a lot of people who want on with Scrub Daddy, for example? What does that do to the investment?
So that's kind of a loaded question. In one way, one of the benefits of that, if we're talking a little bit more about why somebody would want to do an equity offering, you're able to distribute the risks of your company amongst several different people. So instead of just you absorbing all of that risk, you're able to distribute that amongst your board or folks who have equity in your company.
So Erin, why would a company want to give up part of its ownership just to get capital in?
Yeah, so there's a few reasons why folks go this route. One of those things is being able to raise capital without taking on debt. Sometimes companies, a traditional line of credit or a traditional loan is not available to them via a bank. Okay. So this is a way for them to acquire that capital without having to go that way. Also, I kind of mentioned there is an alignment between the equity holders and the overall prosperity of the business, because when the business makes money, they make money. So they're trying their best to help the company succeed. And sometimes, like I also mentioned before, those connections that investors can bring to a company can be really attractive. So it's worth it potentially to that company to exchange a piece of their pie.
Understand. So when you say they might have connections and bring on other investors, what does that do for one shareholder? If you have multiple shareholders, what does that actually do?
Well, so that also helps divide the risk between a bunch of these folks who are coming on to have a piece of this pie, instead of, let's say you start out and it's 80% you and 20% another person.
Okay.
You have essentially 80% of the risk and that other person has 20% of the risk.
Got it.
And then as things go on, if you continue to sliver your pie up, then you will have less risk. You're sharing it amongst people. Now, of course, that means that you have less money at the end of the day, because let's say you end up selling that company, you're only going to get your percentage of the pie.
Got it. So do you always have to give money to get equity in a company, or are there other different ways that you can get a piece of this pie?
Yeah, so if we're talking about people who are not investors, sometimes this is typically very popular with startup companies. They'll give equity to their employees. And again, that's to align the motivations of the company and the employee, just like with the investor, because when the company succeeds, then that employee has a piece of that pie, they make more money, et cetera, et cetera.
Well, you're probably going to work harder if you're an employee to make the business successful if you know that you get a reward in the end.
Yeah.
It's just like when a rental car, like nobody treats a rental car nice. It's not theirs, but you're going to treat your car a heck of a lot nicer.
Yeah.
Because at the end of the day, if you go to resell that car, all that money goes to you. So you're going to make sure that it's doing well.
Exactly. You're reaping those benefits.
Awesome.
So for diving in further into equity, Erica, can you tell me about private equity, a certain type of equity offering?
Yeah, so private equity comes into play at different points along a company's life cycle. So it describes the investment partnership where a company a lot of times will come in and buy out a different company that might be failing, and they want to rebuild it. Kind of think of like house flipping. So you go in, you fix it up. It's kind of a short-term thing, and then you sell it hopefully for more profit. So private equity firms operate these investment funds on behalf, a lot of times, of an actual institution or an accredited investor. It's a little bit different than venture capitalists because most private equity firms invest in maturing companies. Like I said, those ones that have already kind of, their little life cycle has run and it's kind of going downhill, and they're like, but they don't really want to give up yet. So that's where these private equity comes in to kind of help them rebuild them, and then they resell them.
Yeah.
Now, another type of equity that I like that is from the very beginning is like your angel investors. This is your family and friend. They are your angel that come in and save you. So a lot of times, like younger companies, they don't have any revenue. They don't have any, credit to show like, hey, this product's going to be great.
Right.
You got to go on vibes.
Yeah.
Like you have to.
Angel investors succeeding only on vibes.
Succeeding only on vibes. Exactly. So it's normal. It's not a business loan, but they're going to give some of their money because they believe in this product. They want to see it successful. They want to see it up and in the market, and to know that their initial funds helped boost it there. Most angel investors are wealthy individuals who have a little bit extra money on the side. Again, I'm going to keep saying this in all of our episodes. If you have extra money and want to give it to me, please do so. Angel me home. So we want to make sure that, they're wealthier individuals who are looking for higher rates of return that are found in these types of investments, these alternative investments. And then for the entrepreneur, an angel investor will actually, they provide them that lifeline. You don't have any money. How do you get money? Again, we talked earlier, you need things like computers and paper and pens, let alone a building to start building, your product. An angel investor gives those funds over so that you can get that going. And as you mentioned multiple times, they don't actually have to pay that debt back to the angel investor, but the angel investor is hoping that this product takes off, successful. They make money, you make money, win-win for all parties. And then there's the last thing that is venture capitalists. I think we've all heard of VCs. And they normally enter the picture when a company has the products ready to go out to market. You've done all the hard work. You've done all the, testing and trying it out on people and getting all that advice from others. And so then the VC comes in and they provide private equity financing in return for an early minority stake. So they come in right at the very beginning. They take a little chunk of the pie. They typically will stay in an investment maybe like 5 to 7 years. Short term, but they're like, here's my money, get this thing going. Boom, you make a ton of money. Thank you for my money. And then they bounce.
Yeah. Yeah, they have an exit strategy.
Exactly. And the coolest thing is that I don't think a lot of people actually even realize is some of the largest, most successful corporations in the tech sector actually started with venture capital. Google, Apple, Amazon, Meta. They all started using venture capitalists at the very beginning.
Yeah, that's pretty cool. Okay, so an entrepreneur has a product. Now, what do they do? First things first, we always talk about research. Research your investors. Identify the investors who have relevant expertise, network, track record. Again, you can utilize these things that a investor has that can help get your business off the ground.
We talked about it in Shark Tank. Those investors that invest in these ones, they have people who have similar interests and understand your product. That's what you want to go for.
Yeah, that can be super helpful. You need to learn about their investment criteria, their preferences, expectations, how they evaluate startups so that you can provide them with an offering that's attractive to them or at least have a better shot at reaching a deal.
Awesome.
Another thing that you should do is establish your valuation, something else you'll see on Shark Tank. Shark Tank is really like a great crash course for just kind of like a quick, how do companies raise capital?
Yeah.
So a lot of the times they'll have their valuation numbers. How much equity are you willing to give up for funding? And they need to have a realistic evaluation of their company that reflects the startup's potential and performance. And that helps the sharks and investors understand exactly where this company is going. Has it been successful thus far? What are some of the pitfalls that have been coming? Sometimes those companies are coming on to Shark Tank to raise capital to help fix a problem or a pitfall that they are encountering. So the sharks want to know that, right? And any investor wants to know that.
Yeah. Well, it always comes back down to research and giving due diligence is that research.
Exactly. And that's what I was just going to top it off with. Yeah. The amount of times that you'll hear us say due diligence. Yeah, I was going to say you could make it a drinking game, but I don't advise that. Again, what is our due diligence? We're organizing and documenting all of the relevant information and materials that investors will request when they need to make a decision about potentially investing in your product or company.
Got it.
And this needs to be clear, comprehensive, an overview of the legal, financial, technical, operational aspects. It's basically putting together everything that you have about your company, and that's everything that an investor is going to want to know.
Yeah, you want to give them all the information up front. Be honest, be transparent. Otherwise, they might not want to invest. If you just give them little tidbits, you might not get that investor. But if you're like, hey, here's my plan, here's what I've got, here's my research, here's my due diligence, all the things, an investor might be like, oh, okay, this guy's got his stuff together. And I can see myself getting on board.
Yeah.
So that's really great. So the advantages of an equity offering, we've talked about a few of them already. One being there's no repayment obligations. The investor makes the money when the company makes the money. Yep. Again, company does well, investor does well. Company doesn't do so well, that sucks. There's no additional financial burden. We talked about it. So once the money is invested, it's the company's money.
Yeah.
So they can kind of do with it whatever they need. If they want to buy amazing fake plants or, coffee mugs, all that good stuff for their company, they have the right to spend that money how they feel fit for their company. And then, of course, the company may gain access to savvy investors with expertise and then even more connections. Yeah. Word of mouth. Hey, I got this cool product. Oh, let me tell my other rich friend. Oh, let me tell my other rich friend. Let me tell my other rich friend. It's great for equity offers to make sure that, you've got this like little network of people. And then, the company can improve by decreasing that debt to equity ratio and then builds their credit score. Yeah. I know a lot of times people think that a credit score is associated with just a human, but it can go to companies as well. And then you want to make sure that, all those interests are aligned. They share a sense of purpose. Again, when the company does well, the investors do well. So there's great benefits, but what do you think like some of the risks are?
Yeah.
Risk in everything.
Yeah.
They made a board game out of it.
Exactly. Yeah. There's risk in anything. So specifically on the company side, that dilution of ownership, which again can be a pro and a con, but at the end, let's say your company really hits it big and you only have a 10% stake in your company that you've worked so hard to build.
You put all the man hours in.
You put all the man hours in. You created the product. You created the thing. And now you're only getting a teeny tiny fraction of the pie because you needed to raise capital. And this is how you did it, right? So that's one thing that could be a bummer. Also, you can, because of that smaller piece of the pie, you can actually lose control of your company. And in the sense that if you have a 10 to 20% stake and other people also have 10 to 20% stakes in the company, your voice matters just as much as the other voices matter in the sense of the pie. Even though you are the person that created the product or the company, your voice has now been diluted.
Got it.
And also, equity typically costs more than debt financing due to higher risk. We have legal, accounting, underwriting, and other advisory fees that are associated, so that can be costly. And it's also often harder to find an investor than a lender. So, a lot of those people we talked about go to an equity offering because they don't have other options.
Got it.
So that's just something to think about. And then for investors, again, we mentioned when the company makes money, you make money. That also means if the company doesn't make money, you don't make money.
Right.
And vice versa. If they lose money, you lose money. So that obviously with any investment, that's a risk.
I got it.
And then also dilution risk. If you come in at the start of a company and you have a 20% or 20% stake in the company, if they continue to bring more people on, similarly to the company's creator, your voice and power can also be diluted as well.
Got it.
So that's
your piece of the pie gets a little bit smaller as more people hop on wanting a piece of the pie.
Yeah, exactly. And also, there's business risk. Companies face operational changes, market disruptions, regulatory changes, things that, this is business, this is what happens. But of course, those risks can affect how your investment performs.
I see. So let's just wrap this episode up just talking about that case study from Shark Tank one more time. You said looks like Lori probably made roughly around 50 million.
Not 18 million.
Not 18.
This girl's swimming in the scrub daddies.
Yeah.
So it's $50 million.
For a sponge.
Yes. And of course, these are estimates, but that's pretty amazing. And the CEO and founder, Aaron Krause, is worth $70 million. So
that ain't too shabby.
Pretty good. And Scrub Daddy overall is now worth $200 million. So it's a very popular and successful company. So, that particular investment was super helpful to his company overall. But we have heard about this success story. What if there was another way?
Well, I think we should definitely talk about that. And we'll do so in next episode. So next time we're going to talk about debt offering, which is a different type of way to raise capital. Stay tuned.
Thanks for joining us. Stay tuned for more insight on our next episode. And don't forget to subscribe to continue the journey with M2I. See you next time.
The content provided in this podcast is for informational purposes only and should not be construed as professional, financial, or investment advice. This podcast should not be construed as an offer to sell or a solicitation of any offer to buy any securities. We strongly recommend that you seek advice from a qualified professional before making any financial decisions.